Let's ask Lauren Goodwin of New York Life Investment Management here with me at Post 9. Welcome back. I mean, it has been a resilient market, right? I mean, any dip of late has been bought. Are we running out of gas? I mean, how do you see it heading into what's a huge week next week?
It is so uncomfortable for investors to sit and stew in this no man's land of uncertainty, mixed data, and no good answers. But there are two things actually that I'm looking at next week in terms of where the market might be going next, and specifically the equity market. One of them is actually the employment data on Friday, employment cost index, which I think is really important for this tug of war we're seeing about the Fed. And then, of course, you mentioned tech earnings, specifically revenues, because the market breadth in this upturn has been so focused on these big tech names. I think it gives us a huge indication of whether we'll see up or down in the week after.
You think those stocks are set up for a fall, specifically the mega cap tech ones? And if they are, does that help answer our question of whether those earnings next week save this or sink it?
I think it does help answer the question. Whether the stocks are in for a doozy has to do with revenues, I believe, rather than bottom line earnings.
Well, revenue growth is slowing, obviously. I mean, we've learned that in the prior, quarter or two.
But it's not outright contracting, and I think it's really important to see underneath the headlines how these companies are managing what the rest of the country is feeling in terms of profit margins compressing, because it's when the rest of the corporate sector sees those profit margin compressions that the tech sector starts to see deterioration in revenues, less growth in ads, et cetera. You
feel like the market overall is vulnerable?
I do. Not only from the economic perspective, but also from the lack of breadth that we're seeing. I would highly doubt that I'm the first or even the 10th person to come on the show and say that without the top 10 names in the equity market, you've only got 1.3% equity market return this year. That's really important. But it also tells us what to look for in terms of these tech earnings. So, for example, if you're going to see the market continue to break higher, it's probably not going to be from upward surprises in tech next week. It's going to be because other names are starting to join the party up.
But I mean, if these names next week, then let's just assume the earnings come in well. That's not going to give you the ability to have another leg higher led by those names, maybe at the expense of everything else. For all of the reasons that we've discussed that they've gone up in the first place, better balance sheets, cash on the balance sheet, perceived safety and more defensive plays.
I don't know. I don't know that in a market where quality and uncertainty are so consistently a part of the conversation, if investors are willing to take PE multiples of higher than 30. I think we might have seen the hovering around that quality specific to the media and tech names already.